Welcome back. I saw lots of intensive networking and urgent discussions going on over lunch. It was wonderful. The session after lunch is always a tough one. Everybody's a little sleepy. I promise you, this session is going to keep you awake. It is a terrific group. It is a terrific panel. I'll ask the panel to come up and take their seats while I introduce them. But we've been talking throughout this conference about the investor perspective. Why don't these investors get it? How are investors holding back companies who want to do the right thing, who want to create shared value, from really doing it? And now we really get to have a conversation about investors, and with just a phenomenal panel. David Blood, after 18 years at Goldman Sachs, teamed up with former Vice President Al Gore to create Generation Investment Management, a firm that has a very different approach. A firm that said, we're investing for the long term, and we're going to create a compensation structure for our partners that is based on longer term returns. A firm that said, sustainability has many important dimensions, but there ought to be companies that are more successful because of their approach to sustainability. And if we look for those companies, we ought to outperform. And it's really rewarding that 10 years after David started this, he can indeed say our fund has outperformed because of the focus on sustainability and the focus on long-term investing. Hugh Lawson is from Goldman Sachs, and he is the head of institutional client strategy at Goldman Sachs Asset Management, and he is in charge of their ESG approach. Prior to being at Goldman, he's had a 20-year career at Goldman, but before that was at the Rockefeller Brothers Fund, which has always had a bit of a social lens to their investment performance. Tom DiNapoli is the New York State Comptroller. He took office in 2007. He is the fiduciary who is responsible for the state's public pension fund, one of the largest in the country, and we get to hear from him from the perspective of the asset owner. And Imogen Rose Smith, who is moderating this panel, is an award-winning journalist from Institutional Investor magazine. She has 15 years of experience covering institutional asset managers. I think she has actually written about the three panelists. And of course, what's great about this panel is that Tom is invested, I believe, with David and also works with Hugh. And so this is a panel that didn't just come together for these few minutes with you today, but actually has worked together, has known each other, has followed each other's progress for many years. I look forward to a wonderful discussion. Imogen?
Thank you, and thank you for putting together such a great panel. It is a great panel, and I think these are all investors that get it. You will be pleased to hear. But I think we understand as well why some other investors maybe don't. So with that in mind, Comptroller DiNapoli, why don't we start with you and how you represent values through your investing, and actually whose values is it that you are representing and why?
Good question. I could say that we're representing New York values, as is frequently in the past. But our goal is a very simple one. We are charged with ensuring the retirement security of the 1 million men and women who are members of our retirement system. That includes active employees who hope to be retirees, and beneficiaries. So our values are very much from the perspective of making money to support those pensions, from the perspective of being, in effect, a perpetual investor. Our investment horizon is long-term. We've been around for about 92 years. We expect to be around forever. New York State is not going out of business, and our public employees are always going to be working for the state and securing these benefits. So the values that we bring, particularly to the discussion of sustainability, is that it fits so completely with our perspective of not looking for short-term gain, but really looking for the long term and that broad investment horizon. So the values that we bring are, of course, tied to the bottom line, but they are from the perspective of trying to maximize our investments with investment partners who also share that long-term perspective, that aren't looking for short-term gains and the kind of high risk, high reward, and also potential for great collapse that we went through a few years ago. So that is what informs us when we select investment opportunities. And to the extent that, again, as a large institutional investor, we also have a great deal of money invested passively through index funds. Perhaps we wouldn't have chosen all the companies that we end up having our money in. When you have $178 billion, you're kind of putting it everywhere, right? But those values then inform our engagements with our public equity portfolio. So when there are companies that we're invested in, particularly as part of those index funds, that perhaps are not, from our point of view, engaged in corporate practices that contribute to the long-term sustainability and contribute to protecting our shareholder value, that then informs our corporate governance work and our corporate engagement work. So we take a very broad view, but with that incredibly long-term perspective of being very patient capital and taking the point of view we're in it for the long haul, and we want to be involved with the companies in a very proactive way to make sure that they are protecting the value of our investment. And that certainly has a priority from our point of view on the whole host of issues tied to sustainability.
So in this proxy season, what would you say have been, like the top 5 areas of corporate engagement for you?
Well, there are always so many. We've certainly continued a very active engagement on disclosure of political spending as a consequence of Citizens United. We've continued to have active engagement on worker safety issue, labor rights, both for workers in this country and around the globe. We've done some work on supply chain issues related to the garment industry in Bangladesh. Obviously, the issue of climate is very, very important to us. And coming out of the Paris Agreement, which is a huge milestone and is really changing, I think, the whole face of this discussion and is requiring corporations to look at that issue much more carefully, working with wonderful partners like Ceres. I know Mindy Luber is here. We have been engaged with a number of companies, and probably engagement we're most interested in at the moment is our engagement with ExxonMobil. That corporation has been particularly resistant to incorporating an assessment of the risk of climate change into their business plan, and certainly coming out of Paris, certainly with the regulatory changes that are on the horizon and the international agreements. Exxon certainly needs to step up to the plate and do as some of the similar companies in this area have done, and start to assess what will be the impact of regulatory changes, what will be the impact of the reality of climate change and the impact of global warming, and how are they going to change and update their business plan to adjust to this concern. Now, as some of you may have followed this, we filed our resolution, co-filed it with the Church of England. I figure Church of England is a pretty good partner to have in something like this. And ExxonMobil, in spite of our having the archbishops in Imprimatur, they moved to strike our resolution from their shareholder meeting. Fortunately, the SEC found otherwise. And so we are very much looking forward to later this month to see what kind of a vote will come out of that. Glass Lewis, ISS have come out in support of our resolution, and it's gaining momentum. Whether we'll get an outright victory this time or just a big vote in favor of this, I just think it shows how certainly that issue of climate is evolving. But there are many other issues that we work on, but I guess those are the top few that I would mention right now.
So David, there are investors out there that would say, it's one thing for the Church of England to be out expressing its values within its investments, but generally, values have no place in an investment office, and investors shouldn't be meddling with this stuff. What did you say to that?
Well, I guess I would say two things in separate subjects. The first is values-based organizations, many of whom are in this room, we think are ultimately superior business models. And that includes asset managers, asset owners, NGOs, businesses, et cetera. So values matter to culture, and culture matters to the long-term success of businesses. From an investment perspective, in terms of how we think about managing portfolios, we've actually said very clearly we are not imposing our values on the portfolio. We, in fact, but then beyond that, we will say we will systematically integrate sustainability into how we're analyzing the quality of business and quality of management. And we systematically use sustainability, whether it be environmental challenges, governance challenges, or social challenges, which it can include culture, it can include how you operate in your community, the broader continuum of how businesses operate, the broader continuum of stakeholders. We will consider those in that evaluation, and we do so because we ultimately think it drives the long-term success of business. And in fact, we feel after these 12 years of working on it, and increasingly there's a significant amount of academic research that supports this, as well as other company experience, that because it's clear that sustainability is relevant to the long-term success of business, it is the fiduciary duty of asset managers and by extension asset owners to integrate sustainability into their decision making. So we don't think we're imposing our values, we think we're using sustainability as a tool to make better investment decisions for our clients.
So can you quickly explain, because I think this might be helpful to the audience, sort of the difference between screening and socially responsible investing and ESG or value integration? Because I know that, sustainability, because sort of this is jargon that we as investors use all the time, but I think that the transition from one way of thinking to another explains why sort of these issues now resonate with investors, all types of investors, in a way that they didn't up until, what do you want to say, like the last decade, really.
Right. Well, so we think of the broader sustainability continuum that would include on the one hand, let me just actually start by saying, ultimately, as you can tell by my comment around fiduciary duty, we think sustainable investing is mainstream. We do not consider this to be something different. We expect that over time that all investors will use sustainability as a tool to make investment decisions. We're very confident of that. And the difference today versus 4 years ago, let alone 12 years ago, is night and day in terms of how people think about sustainability. But the journey we've been on, it started where, for a number of years, where some investors would say there's certain types of companies or certain types of businesses we are ethically uncomfortable with, ranging from arms to businesses in South Africa to tobacco products, et cetera. And those investors were called ethical investors, and they made clear value statements. Many of them made that statement because it was their own money or the foundation's money, and it was a very thoughtful approach. And in fact, I personally will have values-based investments in my own portfolio. It then evolved to sort of best in class, where there was a recognition that excluding certain types of companies was would potentially hurt investment returns. It would reduce the opportunity set. So there was a sense of, well, what is the best in class? And so a number of the sustainability indices, whether it be the Dow Jones Sustainability Index or the FTSE for Good, these indices were developed to in some ways get a sense of who were the best companies in these different industries. Ultimately, though, what Generation decided to do, and others have done as well, is to say, no, let's actually turn it upside down and say, because we fundamentally believe that from both a macro perspective and a company's perspective, sustainability drives long-term returns, let's integrate that into the investment process. Let's use sustainability as an investment tool. And so it's a proactive decision to use sustainability in analysis of businesses. Now, the last node is actually impact investing. That's not the purpose of today. Impact investing can be at market rate or it can be at a subsidized rate. And of course, impact investing and charity are very, very similar.
So Hugh, with that in mind, I'm actually interested to sort of hear sort of your story, which is also the GSAM story, about sort of, obviously you've always had sort of screening products, sustainability, but in the recent years, including getting impact investing, you've really, the organization and you have sort of ramped up your efforts and your focus on this.
Well, I think, the panel and the gathering today and yesterday are examples of this. I think in the world that we live in today, large asset owners, particularly of the kind that Tom describes, who are long-term holders of equity interests, you can't compartmentalize the investing function from the broader values that you're trying to support. In a world of information ubiquitousness, you just can't do that. And so all investors, if you're providing capital to a going concern, in some way or another, you're endorsing the broad activities of that, maybe not everything they do, but the general direction of it. And so investors around the world are asking themselves, how does my portfolio line up with the things that I think are most important? And I would say, to David's point, ethically motivated investors using the old lexicon who were screening their securities, that tended to be not necessarily the largest asset owners. I would say in the last 5 years, that's changed. Everybody's asking that question. And so I think we saw an opportunity to help our clients who are of all sizes around the world think through those issues. Now, at the same time, governance of large pools of capital has been improved over the past few decades. I mean, you've got thoughtful decisions around policy benchmarks, you've got clear risk budgeting, you've got clear accountability for who's making decisions. Those structures, the scaffolding around a portfolio, you don't undo lightly. Now, at the same time, it shouldn't be used as an obstacle to thinking about values. So there's a synergy there. You can think about, in a risk-aware and thoughtful manner, how to increase the units of alignment of the portfolio in light of the values that are important. The controller mentioned climate. That's one dimension that investors can focus on. There can be other issues around labor market practices and supply chain. So I think in the realm of near passive or passive investing, I think that's the frame that's state of the art. What David, what you described, which I agree with, is that for the portion of one's portfolio that is driven by active management, where the benchmark is either not relevant at all or is only dimly so, sustainability has to factor into your calculus. How can you be a long-term provider of capital to a going concern that isn't cognizant of the social and environmental context in which it operates and where that's likely to head, and also sees opportunities to make a positive contribution that'll be mutually reinforcing. So I agree, David, with your sentiments that active management and questions of sustainability, that will be core to viable active management going forward.
So you're under strict instructions not to use the word indexing or benchmarking too much in this conversation, but unpack for the audience why this is such an issue for institutional investors. Why can't Controller DiNapoli just be like, you know what, I'm just going to go ahead and invest in the companies that I like. I'm just going to ignore Exxon. I don't want anything to do with that. I'm going to ignore all these companies. Why does this issue of benchmarking prevent such an obstacle to sort of expressing those views that we agree aren't just about values, they're about sustainability going forward?
Well, if you go back to the sort of efficient capital market hypothesis and the publication starting in the 60s, an efficient portfolio would be seen to be what the market cap prescribes. So in essence, the simple decision, if you're a long-term equity owner, is to capture the equity risk premium as represented by the market. You can do so very cheaply and very easily. You don't need particular skill to do that, and it's not an expensive matter. When you introduce active management, you introduce greater cost, greater complexity. Skill becomes a premium. For every David that's out there, there are 20 that are not quite the same. And so
luck is a good thing.
little bit of luck doesn't hurt. And so for large pools of capital, thinking about the index as at least your reference point, which is the term policy benchmark. So even if you don't drive all of your capital up against it, you have to keep it in sight, is just good governance. It's a neutral, cheap way to invest your capital. Am I doing at least as well, or am I doing better with my active decisions? And usually, active decisions are given a risk budget. So as talented as I'm sure the controller would be in picking the stocks that he likes, generally one would give him a risk budget with which to express the views. Now, certain institutions have a bigger one, certain institutions have a smaller one, but the key is that you need to measure. So we could have a long discussion about all this, but having a neutral reference point and thinking about risk management in the context of your active decisions, whether they be values-driven or otherwise, is best practice in investing. So it doesn't need to be an obstacle to doing this, but you need to keep it in mind.
So, given that this is the framework then that institutional investors are investing through, I think, the most important question to this panel, and if we take a crack at answering this question, then we could just win, we could be done, and I can not have to talk in public anymore. But I think, we have all these corporations and representatives of corporations, and they're sitting here and they're doing very good things and working earnestly on all the things that we can agree are important, health, welfare, wellness, sustainability, all of these key issues that you guys have been talking about for a day and a half now. And then they go out and they go to shareholder meetings or they go on road shows and they sit with a bunch of investors and they don't get asked any of these questions. And so why is it that, we're saying the investor community does care about this, but then you go in front of a bunch of analysts and you get asked about quarterly results and earnings? What's the disconnect in the conversation? David, I'm going to start this one with you.
Well, it's a great question, and multiple finance directors or CEOs will actually express that frustration in that perspective. And what we've tried to do more recently is say, well, let's actually recognize that there are multiple stakeholders in the investment community, and you need to understand who it is that you're talking to. So, for example, if you're talking to an organization that is that's a short-term trader, their time horizon, and it unfortunately is increasingly a significant percentage of the market, will be on a short-term questions. Oftentimes, the sell-side community will be most interested in those folks because they're traders, and that's an important part of their revenue stream, and so that's why often analysts will be focused on the shorter term. Then you have longer-term investors, some who actually get confused about whether they're long-term investors, and they actually then ask the short-term questions. And then there's long-term investors who truly are long-term investors. It's important that the finance director or the CEO knows who's in the room, and actually, to be somewhat provocative, there's a fair amount of very good academic work that basically says you get the investors you deserve. So if in fact you are talking in your earnings announcement about short-term factors, it won't be a surprise if you don't begin to get short-term folks into your position or your stock, because in fact that's what they're trading around. If you say that actually we're going to be evaluated on the following long-term matrices and then hold to that and report to that, then chances are you're going to see that increasingly your investor base will be investors who are interested in those sorts of discussions. Now, oftentimes a finance director or CEO will say, well, how do I make that transition? And it's not straightforward. And there are examples of companies who have made that transition extremely well, Unilever being an example, and there's some who don't. But ultimately, our humble opinion is the very best CEOs know that the best way to run their business is with share value on a long-term basis. And on that basis, you ought to be focusing on how do you evaluate whether you're achieving your long-term targets, and you should be reporting on that. And if ultimately you do that, you will find long-term investors in your analyst meetings.
Is it also like an IR function? Like, is there a need to reach out? Like Jeff Immelt said he wants more institutional investors. Does he just like open the door and the institutional investors walk in, or does somebody have to sort of engage with them?
No, you do have to engage, and the challenge that Jeff has is that he has a really, really big company, and there's lots of folks that are going to be in the stock whether he likes it or not. But still, the discipline of saying we're going to run our business for the long term and here's how we're going to be judged, I think you just do it, and you don't really worry about the noise in the room sometimes.
I'll just add there. I think all investing, however it's done, if you the asset owner do it directly, or you the asset owner hire a manager, either a passive one or an active one or somewhere in between, to do it for you, somebody in there has to be accountable for active ownership, right? The model doesn't work if investors are asleep. So even market cap indexation, it just tells you the weights you need to own things. It doesn't say don't be an awake investor. So this is one of the challenges, is that investors need to be attuned to the companies that they're part of, either directly or have somebody on their behalf pay attention to how those companies are treating their shareholders.
Isn't this also a retail investor argument at some point? Then you have it like in an Exxon, for example. The controller DiNapoli can do all the good work that he's doing, but you have a bunch of inert shareholders in the form of mutual funds that won't take that will effectively not have ownership.
I think a lot of mutual funds do have a long-term perspective. Some of the very best managers would have that perspective. And oftentimes you hear people saying, well, the reason why there's not a lot of engagement is there's increasingly a high percentage of assets that are managed according to the broader market as opposed to index. And that's, as Hugh was just saying, that's actually not really correct, because engagement, so I think it's your fiduciary duty to integrate sustainability. It's your fiduciary duty to engage with the businesses that you've invested in. And for a fund manager to say, it doesn't meet my fund model, my economic model, they're not fulfilling their duties. And that is whether it's a more of a passive portfolio or a more active portfolio. Either way, you have the responsibility to engage.
And you're not always sure what will be the result of the engagement. So sometimes we're measured by a shareholder resolution and the vote you get and whether you won or you lost it. If you're persistent, though, in the engagement, and especially if you're doing it over a period of years, you very often find that you will get an agreement. It may not be 100% of what you might have asked for in a resolution, but even in the case of ExxonMobil, we had some LGBT non-discrimination issues, and they resisted. I think we got no more than 22, 23% in a resolution, but they eventually came around on a piece of that because they understood, finally, that if they took a proactive position on it, they wouldn't have to deal with us always pressing them, with resolutions. And I certainly want to endorse what David said and why we're very pleased to be invested with Generation, which is certainly the gold standard from my point of view in terms of sustainable investment opportunities, knowing that that's the philosophy that he's bringing to the management of our money. And in a similar way, picking up on what Hugh was touching on, for our role as institutional investors, the engagement of the way to move the markets of the corporations is not just through the shareholder resolutions and the letter writing and kind of the public campaigns. This issue of climate, which is such a key issue for all of us right now, and should be for all corporations and all citizens. We came up with the challenge of what more can we do in this space. And working with Goldman, which is one of our strategic partners, we were able to develop a low emission index, which for us is a novel approach. It's novel for public pension funds, where we are using that more efficient model for investing, using an index fund, so your fees are obviously lower, and doing it by weighting towards companies that are good corporate citizens, that are first of all disclosing what their carbon footprint is, and identifying for us ways in which they're going to be more effective at controlling greenhouse gas emissions and reducing that carbon footprint. So much of the discussion sometimes gets, from my point of view, stuck into the issue of fossil fuels and divesting from Exxon, and not recognizing the fact that all institutions have a carbon footprint of some time, all have an emissions footprint that needs to be dealt with. So we're very excited about the opportunity by putting our capital in a way that's efficient through this index fund, where over time now we will track whether or not those we're invested in are in fact participating in disclosure of their greenhouse gas emissions and how are they addressing the carbon issue. We can then move our money around and give more money to companies that are doing the right thing, take money away from those that aren't. And that's the way for us to use our market power to generate for us what will be solid returns in an efficient model, but also help to advance what we think is an important agenda that's affecting all of us. So I think that there are some new strategies that are out there, and if you're willing to be creative with those who are your partners, and that will start to change the dialogue and the discussion that is going to be reflected in the companies that are represented here. So whether or not you're getting a letter or you're getting a shareholder resolution at your annual meeting, you're going to start to hear more and more of investors, like a pension fund, moving capital in a way that you're going to have to respond to that.
And does that also result in sort of rewarding good actors instead of spending so much time focused on the bad actors? So again, sort of all these people here working on initiatives, and we as investors, or investors spend all their time banging on Exxon's door. So is this a way of sort of fixing both that problem and also addressing Hugh's indexing concern?
I think it's the old carrot and stick approach. There are times where you're going to go at one of the companies and say, hey, you really need to do better. And there are other ways to just more subtly say, hey, there's a positive here. If you are a better corporate citizen on this issue of climate change, you're going to get more of our capital, and that's going to be good for you.
And I would say most of the, not all, but most of the engagement issues are business issues. You're engaging because you're trying to make the company better. You're trying to make the business better. The goal, of course, is to make that business case and make it clear to the companies. But ultimately, they're going to respond because it's in their long-term interest to do so. And that's why I think they've been very successful. The state of New York has been very successful with a number of their initiatives because it ultimately makes sense to do so.
And Hugh, how much of a challenge was it to put together that index product?
It was a challenge because what we needed to square is...
That was a good thing. You shouldn't have said, oh, it was real easy.
Exactly. Anybody could have done it. Well, there are a couple of issues there. One is, and I think the comptroller said it well, corporations within a given industry that can deliver a unit of market cap, so of shareholder value, by generating relatively less CO2 emissions than their cohort, may very well have an advantage. They certainly have set up their business for where we think the future is headed, and it's good for the planet, but it's also good business. Being efficient in that sense from carbon emissions is a wise thing. And so why wouldn't you tilt your capital toward those companies? Now, at the same time, as a universal asset owner, you wouldn't necessarily put all of your eggs in just those baskets. And so it's an overweighting and underweighting scheme. And then the question becomes, what's the magnitude of the overweights and underweights? So we're going to overweight those that are more efficient, and we're going to underweight those that are less efficient. By how much? Well, the how much is a risk management question. And there's a lot of complicated math that goes into it. But for a very modest amount of tracking error or potential deviation from the large cap benchmark that New York State follows in the US, you can reduce your rateable ownership of emissions by 70%, 70. That's a lot. But you still have fiduciary standards around the investment strategy vis-a-vis the governance structure that you've set for the plan. Now, we're constantly doing research. There will be other metrics that we'll think about that we'll work with the comptroller and the team to integrate. But I think squaring the circle there, we didn't throw out all of the sophisticated governance that the comptroller has put around the pension plan. We worked within it, yet we amplified the climate agenda very successfully. So, and I think there are many, many other opportunities out there. It's not just in this space, and I think it's that creativeness that needs to be applied.
If I could just mention, what's nice about that model as well, it helps also to focus our engagement because we can more clearly identify some of the bad actors that we want to go after. And it's easily scalable. So we moved $2 billion from our public equity portfolio into this index. And we just did this in January. So far, so good, but it's easily scalable to put even more of our dollars there, and that's my goal over the long term. So there's a lot that we like about this model.
So David, when I did the profile on generation last year, one of the things that we were talking about was how, generation's real source of alpha generation is through sort of finding the good actors, right? Finding the companies who are sustainable, who are doing well at the right price. And, you would say ultimately you're sort of, in an ideal world, a generation wouldn't have that source of alpha because everyone would be thinking that way. In some ways, is this sort of GSAM New York Common Index moving into, is this leading into that?
Well, I think there's, as Hugh was...
Not that I'm putting you out of business.
No, it'd be all right, I guess. As Hugh was describing, there are strategies that are more market-oriented, index-oriented, and there are strategies that are more active or idiosyncratic-oriented. We are in that latter category, and we're using sustainability as our tool to help us make differentiated decisions relative to others. And, because we have a small number of companies in our portfolio, around 40 of them, that allows us to, if we do a good job, to ultimately generate better than market returns. It's not a promise, but that's certainly what we're trying to do. we think that it's really a good thing to have index strategies that in fact reflect sustainability and particularly low carbon portfolios. There's no question. So basically, an index strategy is an active strategy. You've actively decided that you're going to have this broader portfolio in your asset mix, and you still have a responsibility for knowing what's in that portfolio. And if you have a point of view that there's risk, carbon risk in that portfolio, it's your job to try to mitigate that risk one way, shape, or form. And so that's just another approach to thinking about managing assets, not different or counter to generation per se.
So taking the conversation away from sort of the more technical asset management issues, we talked a lot about climate, and I think climate is very easy to understand the sustainability narrative and why it might be, today that investors are concerned about that. Social issues tend to be a little more amorphous. And so I wanted to talk in particular about sort of what we're seeing, sort of activism, corporate activism on the part of CEOs, particularly on the LGBTQ issues recently. How do investors grapple with that? I mean, it makes sense that that corporations are doing this, but I don't see how investors plug into the conversation.
Well, let me answer that question in 1 second, but I also say that there are lots of examples of businesses that have run afoul of what we think is proper ethics or social issues. For example, Volkswagen, when you cheat on your climate reporting or your mileage reporting, that's a bad thing. Valiant, when you are charging prices that are just extraordinarily high relative to what is appropriate, ultimately the market and ultimately investors say, no, that's just not right. License to operate matters. From our perspective, a CEO who is engaging, we're not trying to say to a CEO, you're making the right decision or wrong decision per se. We'd like to understand why they're saying what they're saying. And if they are saying we have real concerns about diversity in our workforce, and you are putting, you, the state of X, have decided that you're going to have limitations or prejudices against certain types of folks, we would consider that to be a business issue. It is really hard to get great people, and if you make a decision that you're going to specifically exclude some number of people, ultimately as a CEO who's trying to build a strong, successful business, we would think that would be a business issue. And if that's how they're engaging, that's fine. There are CEOs who would say, we actually support it. And we would consider that to be really stupid, actually, as a business decision. But we would evaluate that in terms of quality of management.
So again, it's not really sort of a values and ethics issue so much as what it tells you
It's information about the quality of management.
Well, yeah, and values and ethics will play out undoubtedly in the viability of those companies. I mean, I don't think you separate the two. I think values and ethics are a business issue.
You want to have access to the best talent. So if you have a corporate culture that's not rewarding people for the value of their work, but for other reasons, you're not going to be able to retain the best talent if you hire it, or people will choose not to work there, or you will have litigation risks, reputational risk and harm. A lot of the companies we invest in, are in the marketplace. Consumers can react if they don't like what they're reading about a particular company or its corporate culture. So it really is, from our point of view, just as David and Hugh said, to ensure that you have a business model that makes sense and works and rewards people based on merit, not on any other factor. And that goes for boards, by the way, as well.
Oh, gosh,
that issue of diversity on boards is one that we've been engaged in with many of our brother and sister funds as well. There aren't enough women reflected on boards. There's not enough diversity in terms of race as well. We need to have corporate America look like America, and that's been a struggle, and we need to focus attention on that issue as well.
So what is it investors need to do to show that they're more present in these conversations? We've talked about sort of what corporations need to do. What could your fellow investors be doing to do more or show that they care about these issues?
Well, what we've been trying to do for 12 years is work with our colleagues in the asset management industry and in the asset owner industry to basically make the business case around sustainable investing. And the good news is that it is robust and quite compelling today, ranging from basically risk management to resource management to proactively looking for businesses that are solving sustainability challenges. These are really robust perspectives. The principles of responsible investing today is something like $35 trillion, $40 trillion. I know it's double counted. I know some folks aren't doing what they're doing. That's up from zero, though, 10 years ago. And so directionally, people are talking about this and thinking about it, and they're doing so ultimately because it makes economic sense. And I will say, though I have an American accent, I live in London, I would say that the folks in America are further behind on this subject than we are in Europe or outside of America. We have to move away from thinking about this as a political question and recognizing it as a business question. And ultimately, given that it's a business question, it's an economic question and investment question.
And I think the simplest thing investors can do is that which is measured is focused on. And so if asset owners ask their investment managers, of whatever kind they may be, to provide them with some simple metrics around how their portfolio lines up along some important ESG issues, that alone is dramatic progress. I mean, that shows that they're an awake and engaged owner, and things that are measured need to be asked about and focused upon. And I think that would be the easiest way to continue to heighten the focus on these issues.
All right, we have 5 minutes left before we go to Q&A. What questions do you guys have for each other?
Oh, that's a new one.
That way I didn't have to
How about we
you.
ask you questions?
You don't have any? I have more questions.
From the audience?
We've got 4 minutes and 40 seconds left for questions from the audience.
I just want to know if they're still making money for us in New York since they're spending time on this panel here.
That's a good question. How often are you in the office? Questions like that.
Fortunately, we have really, really smart people doing those decisions, not me.
And I'm just next door, so I'll get back to my office.
That's true, you
in
can
a
run right
second.
over.
Yeah.
And I have a very good investment team, so only a couple of whom are here. So.
Okay, I have one more question, and then we'll go to Q&A. What trends do you see percolating up? And I actually haven't answered this one, if you guys don't. Like over the next sort of 18 months, or even into the election cycle, what do you think are going to be? Climate change we've talked about. I think that's going to be an ongoing issue. But what are the upcoming issues or concerns that you see in corporations that are going to have an impact on investors, or that investors are going to start discussing?
Well, I think from my point of view, and it touched on something that you mentioned at the start of the discussion in terms of short-termism and looking at the quarterly, we clearly, at least for now, are in a period of lower return. So it's great to do the right thing in terms of sustainable investing, all the issues we've touched on, and others that we haven't had time to touch on. But we still have a number to meet to provide those benefits. And I just think we're headed for a period where it's going to be much tougher because of the fixed income environment, because we see what's happening with the public equities markets, a lot of pressure in terms of the alternatives because of the cost and fees and so on. I think the challenge is going to be making sure we can still make the kind of return that we need to make and not lose sight of the progress that we made on the sustainability agenda that we've been talking about. And I think that it was a little easier in some ways a year or two ago, but we're going to post our results soon. We value our fund on March 31st. It's not going to be one of our better years. And the way the markets are right now, and that still drives a great deal of what our returns are going to be for the year ahead. There are big challenges out there for investors, and weathering that is going to be a big issue for all of us.
Well, David, I mean, you sort of saw that happen in a post-2008 environment. You guys put out that paper in 2010 saying we'd made all this progress on ESG, and then the world burnt down, and you guys stopped paying attention. But in some ways, it felt like 2008, in retrospect, sort of kicked off an even bigger shift. So maybe over the long term, sort of down markets and bad times don't actually hurt the ESG conversation.
No, we don't think it does, because ultimately it's directly related to the long-term success of businesses, and in which will drive returns. And that's ultimately what our job is to do, is to drive strong investment returns for our clients. And again, we are doing so in a mission-oriented way, using sustainability as a tool to make those investment decisions. But maybe another answer to your question, Imogen, is we, particularly given that I live outside the United States, I can see what's happening in the United States in terms of our political discourse. It's not dissimilar outside of the United States, whether that be in Europe or Australia, et cetera. And I think we as investors and we as capital markets professionals, companies need to recognize that income inequality and the uncertainty about economies and uncertainty about job prospects is a real issue. And we may very well, it's in fact, I'm certain that we will not conclude that discussion at the end of this year. And we're certain that increasingly, just like climate change is an issue, income inequality will be an investment issue because ultimately businesses will not be able to hide from it.
That was my answer, the income inequality one.
I knew I saw your notes all the way from here.
Well, which I think goes to the issue of how corporations recruit, retrain talent, go the extra mile to seek talent more broadly. Do they pay fair wages for work? I mean, all of those issues, I think, will be front and center as much as climate and other issues.
Yeah, I feel like there's been a real shift in whatever that is the last year, even less than that, in terms of really those issues coming to the fore for a variety of reasons. Anyway, we hit our mark. And now we have to go to questions from the audience, which are meant to come up on a screen, aren't they? They're meant to be questions. Where is the screen? All right, but I did see one of the questions I actually want someone to answer, which is, the question effectively was, there are financial metrics out there that are measurable. It seems like the ESG metrics are much more amorphous. Is there? I think this was planted by SASB, by the way. So is there anything out there that is going to change that? And I think SASB is part of that answer. So if somebody could explain what SASB is, that might be helpful.
Well, I think like conventional accounting metrics, you have FASB. So there are certain standards for reporting, how revenue is counted and calculated and costs and so forth. You've got similar issues that investors need disclosure on ESG metrics, but there's no agreed upon framework for doing that. So I think SASB is an effort to do that. There are others. I mean, I think, David, you're on a task force that's focused on that issue. So as I said earlier, I think that which is measured is attended to. And so I think having standard disclosures around these key metrics help investors and help corporations also focus on them.
We would add that integrated reporting is a subject that increasingly companies are thinking about, and what that is integrating the sustainability issues that are ultimately drivers of their success into the financial reports, as opposed to having a ESG report and a financial report. And so from our perspective, we often get a question of, you've outperformed by X, what percentage of your outperformance is due to sustainability and what percentage is due to just good stock picking? And we answer, we have no idea. And we have no idea because ultimately sustainability is integral to the success of business. And we don't try to quantify an environmental impact versus a social impact. It's part of an assessment of the probability of success of a business. It's part of an assessment of the quality of management. And lest you think that non-sustainability issues are the only ones that can be quantified, I remind you actually that much of on a balance sheet or an income statement are estimates. And so just because you see a number for one issue and it's more difficult to quantify a sustainability issue doesn't mean that one is more concrete versus the other. They all are part of a blueprint or an assessment of a company. And as investors, we're trying to make a value judgment on a lot of different factors. And the extent that you get fixated on a specific number or not, I can assure you that will be a sad process, because one thing we know about all of our models is that they're wrong. And it's better to get a broader sense of ultimately what you think are driving the success of the business and make a judgment on that.
So I apologize, apparently I was having so much fun moderating that we skipped the Q&A part. So we are done. and we'll be
So they're
summoning
escorting us off the premises?
They're summoning us off the stage, but people can catch you in the hallways and ask you their questions themselves.
Thank you.
I apologize.